What does driving a car, riding a roller coaster, or eating a spicy meal have to do with your finances? It's all about risk and your ability to take it, because it turns out that investing wisely is much more than just having some spare cash and an investment opportunity. In this episode of How to Invest by Julius Baer, we're talking about you and your ability to take risk. So why are we talking about risk? Because understanding your willingness and ability to take risk ultimately impacts the investments you choose and your possible returns. One way to measure your own risk tolerance is to reflect on past financial decisions and how you reacted during a past market meltdown. Did you stay invested or panic and sell? Or if you're a first-time investor, let me ask you this. If the market dropped by 20% this week, would it keep you up at night? If the answer is yes, you might be more conservative than you think. Just because you enjoy a good roller coaster, it doesn't mean you'll want to take big risks with your finances. How you handle financial ups and downs could be very different. Based on how much risk you can tolerate, investors are classified as having a high, moderate, or conservative risk tolerance. An investor with high risk tolerance chooses investments that emphasize capital appreciation. Their investment portfolio commonly includes a large proportion of stocks. They buy little or no bonds or hold cash at all. And it makes sense because bonds and cash are less volatile than equities, so yield fewer profits. The higher the risk, the higher the potential reward. You remember the financial crisis of 2008? Well, in just 4 days in early October, the S&P 500 fell more than 20%. Not only can an investor with a high tolerance for risk handle the stress of potentially losing some of their previous gains, they can also benefit from these large fluctuations by jumping on stocks that have dropped in price as a result of the crash. So when the market rebounds, they can position themselves for substantial gains. A moderate investor wants to grow their money without risking too many losses. This investor's approach is sometimes described as a balanced strategy, which includes a mixture of stocks and bonds. A common portfolio setup is the 60-40 structure. 60% stocks for growth, plus 40% bonds for stability and income. It's a good middle ground because it balances risk and return, and it's also easy to manage and very popular as a result. Conservative investors, on the other hand, do not feel comfortable seeing the value of their investments go up and down like a roller coaster. They prefer to invest in relatively stable financial instruments such as bonds, bond funds, and income funds. So we've had a look now at the basic differences between high, moderate, and conservative risk tolerance. But don't forget, you can also mix and match a bit too. It's a bit like going to a restaurant and ordering spicy food when you know that your taste buds might be a little challenged. You can try a spicier investment from time to time, but keep your core investment strategy on par with your usual risk tolerance. And the odd night out for something spicier won't keep you up at night. While knowing your own risk tolerance is critical to your investment strategy, you also need to consider 3 more aspects: your cash needs, your financial goals, and very importantly, your time horizon. Because at my age, I might not be as high risk as I used to be. Investing, as it is in life, is often a bit like driving a car. Sometimes you want to go faster, sometimes more slowly. When you're young, you can afford to go faster, take on more risk because you have more time to recover any losses. You're still working, so the next paycheck is just around the corner. In your middle age, you still need that growth, but you also want some stability as retirement gets closer. So you might want to diversify with a mix of stocks and bonds. And then as you approach retirement, you want to preserve as much of what you've built as possible. As you will not be working anymore, you will rely on a stable income stream from your investments and switch to even safer financial instruments like bonds and dividend-paying stocks. Risk is all about knowing yourself and your circumstances. What kind of roller coaster, spice level, or journey are you ready for? Understanding how you feel and react during the ups and downs will help you make good investment decisions in the long run. You don't want to be selling every time you're spooked by market moves, so understanding your risk tolerance will help you make smarter investment choices and help you stick to your plan. Check out our previous episode on building a portfolio to suit your risk tolerance. It's already available on our YouTube channel, and like and subscribe to stay up to date on our latest episodes.